That's how $300 billion of stablecoins today can take down a $100 trillion world economy tomorrow. The world's safest risk-free asset, a U.S. Treasury, will become reliant on the world's most risky asset, a cryptocurrency, for its value. America's ruling elite have the psychology of a manic gambler on a losing streak who thinks that if only he bets his house, a win will come. Will stablecoins crash the economy? The total supply of stablecoins, or digital assets with a 1-to-1 peg to the US dollar, recently rose to the $300 billion threshold. It grew by 42% in 1 year. If it keeps growing at that rate, it will reach $1.2 trillion by 2030. This is just shy of U.S. Treasury Secretary Scott Bessent's $2 to $3 trillion forecast and Citi's $1.9 trillion base case forecast. This matters to the general economy because stablecoins are quickly becoming important buyers of U.S. debt. Stablecoins buy U.S. debt to form their base of reserves backing their value. In effect, stablecoins act as pass-through entities for U.S. debt. As ARK Investment Management wrote, without a hint of irony, mind you, quote, stablecoins have become a Trojan horse for U.S. debt, ensuring continued, if not higher, demand for U.S. treasuries, end quote. Stablecoins are like the critical block in the wobbling Jenga tower that is U.S. debt. And if anything knocks it out, then the whole tower comes down. Forecast for stablecoins, treasuries, and debt. Stablecoins hold about $155 billion in U.S. treasuries as reserves. If the previous forecasts are to be assumed, stablecoins holdings of treasuries could rise to $600 billion at a 50% reserve ratio with a $1.2 trillion total stablecoin supply at the low end, or $2.4 trillion at an 80% reserve ratio with a $3 trillion total stablecoin supply at the high end. Based on recent Congressional Budget Office, or CBO, forecasts, the U.S. total debt should stand at about $44.4 trillion by 2030, augmented by the 2020 CBO forecast with 2025 CBO revisions for the One Big Beautiful Bill Act's deficit increases. The additional $6.4 trillion of new debt will rely heavily on short-duration treasuries for most of its funding. Treasury bills, or T-bills, have durations of 4 to 52 weeks. As of now, T-bills comprise about 20% of total U.S. debt. The U.S. Treasury recommended that 20% is an appropriate allocation relative to trade-offs between cost and volatility. But T-bills made up about 80% of recent sales in overall treasuries. It just so happens that T-bills are the only type of treasuries that stablecoin issuers buy too. They do so for liquidity concerns and requirements of 2025's Genius Act. The U.S. government is relying on shorter duration treasuries because investor demand for longer duration treasuries has diminished while it has increased for the short end. T. Rowe Price forecasted that T-bills will comprise 23 to 25% of total debt. Citibank suggested it could hit as high as 26%. From a historical perspective, it reached 35% in November 2008. T-bill issuance usually surges during recessionary periods, according to the U.S. Treasury. Let's say the T-bill share rises to 25% by 2030. This would result in an additional $4.9 trillion in issued T-bills and compose 77% of the overall additional debt of $6.4 trillion, which corresponds to the composition of recent sales. Of the additional T-bill demand, additional stablecoin supply would represent 9% on the low end and 46% on the high end, based on the previous estimates. Currently, U.S. money market funds hold 33% of overall T-bills for perspective. stablecoins would likely surpass most, if not every, foreign government's holdings. Citibank claimed, quote, stablecoin issuers could hold more U.S. Treasuries by 2030 than any single jurisdiction today. On May 19, 2025, Senator Bill Hagerty, who drafted the 2025 Genius Act focused on stablecoins, tweeted, quote, stablecoin issuers will be the largest holders of U.S. Treasuries in the world, end quote. On June 18, 2025, U.S. Treasury Secretary Scott Bessent said, quote, stablecoins could end up being one of the largest buyers of U.S. Treasuries or T-bills, end quote. Effects of stablecoins on treasuries and more. Stablecoins are poised to become dominant players in the market for U.S. Treasuries. Given that prominent financial institutions like Citi and Treasury Secretary Bessent lean towards a very optimistic view of stablecoin growth, it is not something to ignore. Some observers have already noted novel effects of stablecoins. These effects reveal the problem of stablecoin saturation in the Treasury market. Nobel Prize-winning economist Jean Tirole warned of stablecoin risks that could lead to future financial crises in August of 2025. Other observers have further elaborated exactly how stablecoin effects could translate into very negative outcomes. Economists Rashad Ahmed's and Inaki Aldassaro's Stablecoins and Safe Asset Prices, published in May of 2025 for the Bank for International Settlements, BIS, stated that, quote, stablecoin flows compress short-term T-bill yields, with effects comparable to that of small-scale quantitative easing on long-term yields. The estimates are implausibly large, as they imply an impact on short-term yields similar to that of a Federal Reserve interest rate cut. In a scenario where stablecoins become very large, stablecoin-driven yield compression may weaken the Fed's control over short-term rates. They continued, quote, as the stablecoin sector continues to grow, it is not unreasonable to expect their footprint in Treasury markets to also increase. Suppose the stablecoin sector grows tenfold to $2 trillion by 2028, as suggested by the Treasury Borrowing Advisory Committee, and the variance of 5-day flows increases proportionally. Then a two-standard deviation flow would amount to roughly $11 billion, with an estimated impact of negative 6.28 to negative 7.85 basis points on T-bill yields. These estimates suggest that a growing stablecoin sector may eventually suppress short-term yields to an extent that meaningfully influences the transmission of Fed monetary policy to market-based yields, end quote. Finally, they concluded, quote, there are clear financial stability implications that arise from stablecoins becoming large investors in Treasury markets. As discussed in the literature on stablecoins, they remain runnable, with their balance sheets subject to both liquidity and interest rate risk, as well as some credit risk exposures. As such, concentrated positions in T-bills, particularly those which are not set to immediately mature, may subject the market to fire sales if a major stablecoin were to face severe redemption stress, not least given the absence of discount window or lender of last resort access. The evidence we present on asymmetric effects suggests that the impact of stablecoins on the Treasury market is likely to be larger in such environments, characterized by large and sharp outflows. In this regard, the magnitudes suggested by our estimates are likely to be a lower bound, since they are obtained based on sample that includes mostly a growing market, where there is more leeway in the timing of purchases. The financial stability impact of such fire sales may not be significant while the stablecoin sector is small, but this may change as the stablecoin sector grows, contributing to growing concerns about the stability of the Treasury market, end quote. Economists Marcus Demery and Nicholas Florian Taft wrote, stablecoins and U.S. national debt is a new financial crisis looming. Translated from German to English by Google Translate in October of 2025 for the German Economic Institute, IW. They wrote, quote, stablecoins would be prone to a run risk. If panicking holders of a large stablecoin could try to withdraw money, this will force its management to enact fire sales, of the fund's bonds, which could trigger a price drop of U.S. government bonds. Because of the high global importance of the U.S. capital market as a safe haven, this could trigger a global financial crisis. Further, stablecoins connect the government, bond market, and the cryptocurrency market, as government bonds are the asset side of stablecoins. U.S. Treasury bills, or T-bills, and repo transactions, or repos, are among the most important financial instruments in global finance, and U.S. money market funds are key players in both T-bill and repo markets. Dorr et al. 2023 show that T-bill interest rates decrease when money market funds invest a larger portion of their assets under management in the money market. Stablecoins could develop a similar significance for the T-bill market in the future as money market funds do. According to a presentation by the Treasury Borrowing Advisory Committee, TBAC, on April 30th, a group of senior bankers, asset managers, and hedge fund representatives that advise the Treasury Department quarterly, stablecoins could generate an additional $1 trillion in demand for Treasury bills in the near future. Citi's research team has calculated that by 2030, stablecoin issuers could surpass every single foreign country in holdings of U.S. Treasury debt. Crypto users worldwide could become new lenders to the U.S. government through the growth of stablecoins. Critically, the link between U.S. Treasury debt and stablecoins could pose risks to global financial stability. If the U.S. Treasury market were to come under pressure, stablecoins would no longer represent safe assets for customers, serving as a form of monetary claim. Furthermore, if a major stablecoin issuer were to collapse, it might be forced to dump massive amounts of Treasury debt, destabilizing the market. Similar to money market funds, stablecoins face a genuine run risk. Panicked customers could withdraw their funds immediately, triggering instant selling pressure and potentially leading to emergency sales of the stablecoin's assets, which could cause a price collapse in U.S. Treasury debt. Since a large portion of institutional investors, such as insurance companies and pension funds, hold Treasury debt, these losses would spread to a significant part of the financial system. Moreover, a loss of confidence in this most important safe asset could destabilize global financial markets. As for a case study, quote, a prominent example of a run on a money market fund occurred at the beginning of the global financial crisis. In 2008, the Reserve Primary Fund, with assets of $62.5 billion, was the third largest money market fund in the world. After the U.S. investment bank Lehman Brothers filed for bankruptcy on September 15, 2008, a $785 million investment of the Reserve Primary Fund in Lehman debt securities was at risk of default. At the same time, the fund faced intense redemption pressure from investors, amounting to a bank run on the money market fund. In just 2 days, redemption requests exceeded $40 billion. Since the fund was unable to sell assets without incurring losses, and its sponsor, the Reserve Management Company, Inc., RMCI, unable to support investors, saw the net asset value per share fall below 0.995 cents, making it impossible to redeem shares from the fund at a 1-to-1 ratio. Reserve primary fund investors received approximately half of their capital back at the end of October 2008. Thus, quote, a similar development could occur in the stablecoin market. This would be exacerbated by a lack of transparency in the market, preventing market participants from knowing which trading partners would be affected by losses in a crisis. Similar to the aftermath of the Lehman Brothers collapse, this could lead to a drying up of the money market in the form of a crisis of confidence, which could then trigger liquidity problems for other market participants. A loss of confidence in the most important global safe asset would then precipitate a global financial crisis. If a large stablecoin issuer collapses, it could be forced to dump massive amounts of government bonds, which would destabilize the market. Similar to money market funds, stablecoins face a run risk. Panicked customers could withdraw their funds immediately, triggering selling pressure and potentially leading to emergency sales on the asset side of the stablecoin, which could then cause a price collapse in U.S. Treasury bonds. Given the high global importance of the U.S. capital market as a safe haven and U.S. Treasury bonds as a safe asset, this could then trigger a global financial crisis. Professor of law with expertise in banking law, Hilary J. Allen wrote DeFi, Shadow Banking 2.0, in January of 2023 for William and Mary Law Review Journal. She wrote, quote, "Runs happen when people lose confidence that a particular asset, like a share in a money market fund, will continue to retain its value and function as expected. Right now, it appears that the vast majority of stablecoins are not being used for payments for real-world goods and services. Instead, the recent exponential growth in stablecoin usage has been driven by people who have purchased stablecoins to speculate in the crypto markets. U.S. Securities and Exchange Commission (SEC) Chair Gary Gensler has described them as poker chips that are the price of admission to the casino. If something were to shake confidence in stablecoins' acceptance in the crypto ecosystem, this something could range from a hack to a problem with the reserve of assets backing a stablecoin to a problem with the smart contracts managing the value of a decentralized stablecoin to a loss of confidence in the stablecoin issuer. We could then expect holders to start redeeming their stablecoins when they could. This would force stablecoin issuers to start liquidating the reserve of assets backing the stablecoin, depressing the market value of those assets. Whether this kind of run would pose a significant threat to the broader financial system and economy depends on the contents of stablecoins' reserves. If centralized stablecoin issuers start to become an important source of capital for the real economy, as money market funds did before them, then runs on stablecoins will be a potential source of systemic risk. In her September of 2025 Project Syndicate article, Allen also wrote, quote, "By opening the floodgates for stablecoins, Congress has made the U.S. financial system more vulnerable to crises, increased the chances of government bailouts for tech platforms, and further entrenched Silicon Valley's political power," end quote. Professor Emeritus of Law with expertise in economics and finance, Arthur E. Wilmarth wrote, "Congress must reject the Genius Act and remove the dangers posed by non-bank stablecoins," in July of 2025 for Open Banker. He wrote, quote, "Stablecoins are primarily used as payment instruments for speculating in crypto assets with fluctuating values and conducting illicit activities. Despite the promises made by stablecoin issuers, stablecoins have proven to be anything but stable. More than 20 stablecoins collapsed between 2016 and 2022. And every leading global stablecoin, including USDT and USDC, lost its peg on multiple occasions between 2019 and 2023. Further, non-bank stablecoins invest their reserves in traditional financial instruments, making them vulnerable to serious disruptions occurring in traditional financial markets. When Silicon Valley Bank failed during the regional banking crisis of 2023, SVB's largest uninsured depositor turned out to be Circle, which held $3.3 billion of USDC's reserves at Silicon Valley Bank. USDC experienced a major run after Silicon Valley Bank failed, and USDC's value fell to 87 cents. USDC avoided a complete collapse only because the federal government decided to rescue Circle and Silicon Valley Bank's other uninsured depositors. Thus, we've already experienced our first government bailout of uninsured non-bank stablecoins. Thus, the Genius Act would allow uninsured non-bank stablecoins to become a dangerous new form of shadow deposits and create a shadow banking 2.0 regime. The Genius Act would also permit non-bank stablecoin issuers to sell crypto derivatives and other crypto investments that are determined by federal and state regulators to be incidental to the activities of crypto asset service providers, Such high-risk investments would inflate a subprime 2.0 crypto bubble by producing multiple highly leveraged bets on crypto assets with fluctuating values. The resulting pile of speculative bets on crypto assets would resemble the toxic pyramid of bets on subprime mortgages, which large financial institutions created by issuing trillions of dollars of financial and credit derivatives during the subprime 1.0 credit boom of the early 2000s. Finally, the collapse of the subprime 1.0 credit boom caused the global financial crisis of 2007 to 2009. The speculative crypto bubble produced by shadow banking 2.0 and subprime 2.0 would almost certainly lead to a similarly devastating crash, with highly damaging spillover effects on traditional financial markets. Federal agencies would be hard-pressed to contain such a crash by arranging bailouts comparable to those 2007 to 2009 and 2020 to 2021. Given the federal government's massive and rapidly growing debt burden, such bailouts might well trigger a systemic crisis in the Treasury bond market, as well as a significant depreciation of the US dollar. End quote. And finally, straight from the horse's mouth, the U.S. Treasury Borrowing Advisory Committee, or TBAC, produced a report called Digital Money in April of 2025. It wrote, quote, historical stablecoin DPEGs have highlighted run risk and the potential need for stablecoin issuers to have more access to markets akin to banks. However, the narrow reserve requirements proposed by current legislation resembles money market fund regulatory reforms aimed at mitigating break the buck scenarios. Moody's defines a DPEG as a stablecoin fluctuating by more than 3% in a day against their fiat currency peg. DPEGs can be driven by macro, coin-specific, or economic factors. In 2022, there were 2,347 DPEGs and 1,914 DPEGs up to November 2023. These DPEGs demonstrate what a run on the bank could look like for stablecoins and the corresponding volatility stablecoin issuers need to navigate during periods of stress. One of the more notable DPEGs was USDC in March 2023, which highlighted the interconnectivity between the traditional banking and digital assets markets. A major depegging event has the potential to create a loss of confidence and trigger withdrawals. In turn, this could lead to potentially dampening crypto market liquidity, triggering automated liquidations, impairing crypto trading platforms' ability to meet redemptions, and potentially having a broader contagion effect on the financial system. End quote. Description of a hypothetical stablecoin crash. That was a lot of information, but what does it all mean? Simply, the more stablecoins grow and connect into the Treasury market, the more risk the Treasury market incurs. Since Treasuries are foundational to the overall economy, that risk permeates far and wide. Returning to our Jenga tower analogy, stablecoins will become the critical block holding up the tower, but it's made of sugar. Unlike the other blocks made of wood, the sugar is much more prone to risk. If water splashes on the sugar block, then it will instantly disintegrate, taking the whole tower down with it. Here's a hypothetical scenario of how a stablecoin crash could happen. In the near future, stablecoins expanded and are a major holder of U.S. debt. This would also imply an expanded total cryptocurrency market. Let's suggest about $30 trillion for the total cryptocurrency market cap if total stablecoin supply was $2 trillion, based on prior estimates. Looking at the largest and most robust cryptocurrency, Bitcoin's volatility is about 5 times that of the S&P 500s. Considering the chaotic nature of smaller cryptocurrencies and future tokenized derivatives, as described by Wilmarth, the overall cryptocurrency market will be much riskier. The chaotic market of cryptocurrencies are tied at the hip to their safer stablecoin cousins because 90% of stablecoin activity is in cryptocurrency trading. Rather than fiat currencies, cryptocurrency traders have opted for stablecoins as the dominant trading medium of exchange because of its deregulated benefits. Thus, any buying and selling of cryptocurrencies require the facilitation of stablecoins and especially their centralized stablecoin issuers that handle deposits and withdrawals. Now, let's say a cryptocurrency called Schmuckcoin went viral. It got tons of buying volume and its price skyrocketed. But its underlying software code was bad and created a bunch of bugs. This spooks Schmuckcoin investors and they run for the exits. Investors sell their Schmuckcoins for stablecoins because that's the dominant trading token, and then have to take a second step to sell or redeem their stablecoins for US dollars. Investors in other cryptocurrencies see Schmuckcoin's price plummeting from the selling pressure and wonder, is my coin next? This triggers a stampede of investors in other cryptocurrencies selling out of fear. The rapid selling starts blowing up collateralized cryptocurrency contracts, inducing more selling. This tidal wave of selling all gets funneled to the narrow off-ramps of stablecoins. Once positioned in stablecoins, investors will finish their flight to safety by trading out of stablecoins and into US dollars, whether through an open market or directly with the stablecoin issuers. Given that stablecoin issuers don't hold large quantities of actual US dollars, they will not be able to accommodate the speed and scale of redemptions. This will trigger the open market to panic and start selling stablecoins below their one-to-one value, thus breaking their peg. As other stablecoin holders see that each stablecoin is dropping below the promised $1, they will join the selling pressure. Stablecoin issuers now must start selling their reserves to get the cash needed for redemptions. The bulk of those reserves are, of course, US Treasuries. Stablecoin issuers spread the fire sale to the Treasury market. Stablecoins already exhibit a disproportionate effect on Treasuries according to the BIS study, and that effect will be even larger with an expanded total stablecoin supply. This drives Treasury prices down and yields up. Any other entity using Treasuries as collateral or reserves face margin calls and unrealized losses, which forces them to sell other traditional assets like equities and bonds. This destabilizes confidence in the overall economy as Schmuckcoin's fire sale ripples out like a contagion to the global economy. Zooming out, the increased yields of treasuries jack up rates of all lending. This makes everything from consumer loans to mortgages to corporate debt more expensive. The price of credit surges just as the economy is contracting and in need of it. As an additional systemic factor, stablecoins compete with private banks for US dollar depositors. The expansion of stablecoins will induce a shift of private bank deposits towards stablecoins by mathematical certainty. Since banks need deposits as the basis for their capacity to loan, a contraction of deposits means a contraction in lending in the overall economy. This is made worse because stablecoin issuers don't lend to the economy like banks, but purchase treasuries as a substitute for loans. In August of 2025, Stefan A. Jaswitz of the Kansas City Federal Reserve Bank wrote, quote, "Shifting funds from banks to stablecoin issuers would also mechanically reduce the potential supply of loans to the economy," end quote. Finally, the U.S. government faces the dual problem of the fire sale substantially increasing its interest payments and the collapse of stablecoins blowing a huge hole in demand for future debt issuance that it was relying on that won't be replaced. This forces the U.S. into a debt crisis, where it can either hyperinflate the U.S. dollar through central bank debt monetization or default on its debt. Either option further fractures the global economy, highly dependent on the U.S. That's how $300 billion of stablecoins today can take down a $100 trillion world economy tomorrow. The world's safest risk-free asset, a U.S. Treasury, will become reliant on the world's most risky asset, a cryptocurrency, for its value. Conclusion. In the past 25 years, the stock market has crashed 5 times. .com, housing crisis, start of COVID, end of COVID, and Trump's tariffs. Over the next 25 years, do you think the cryptocurrency market will have a major crash? Recall, the cryptocurrency market is at least 5 times more volatile than the stock market. I don't think one needs to reach far into the realm of fantasy to conclude that another major cryptocurrency crash is all but inevitable. The sooner that crash happens, the less impact it will have on the U.S. Treasury market and the global economy. The later that crash happens, the more impact it will have on both. While one could argue that there's been risks and problems before, the stablecoin paradigm the U.S. has ushered in is quite unique. A critical purchaser of U.S. debt has never been so big yet so mired in volatility and alleged criminality as cryptocurrencies. This intersects at a time when the U.S. government has never been more stressed by its spending and debt. The U.S. is reaching all-time highs in debt to GDP ratios as entitlement costs and interest payments balloon. This is a crossing of the Rubicon moment in economic history. In a certain respect, the inevitable stablecoin crash may be America's last crash, or at least this iteration of America. After all, France is on its 5th republic. However, there are ways to prevent this. First, the U.S. government has to regulate the cryptocurrency sector for real and stop actively enabling it. Most importantly, it has to prohibit stablecoins from buying treasuries and exposing cryptocurrency risk to itself. Then it must deal with the reason why the U.S. government supported stablecoins in the first place, namely a buyer of last resort for its growing debt as global demand for its debt decreases. The solutions to this problem are to grow, tax, and cut. In regards to grow, the U.S. debt is growing at about 4.5% per year, but forecasters like the CBO estimate GDP growth no higher than 2%. The reasons for America's low growth are as follows. America's inverted demographic pyramid results in diminished economic growth because there are more old people consuming and less young people working. Parasitical crony capitalists substitute speculative investment and rent extraction for productive investment and value creation. Finally, de-dollarization reduces the purchasing power of the dollar, making imports more expensive and pushes foreign capital away from investing in the U.S. If America reverses these issues, it can have a better chance of growing. America would need to increase the productivity of labor to offset the inverted demographics, intervene in the economy to direct capital towards the most societal, productive uses, and stop its madman foreign policy rattling trading partners to ditch the dollar. In regards to tax increases can and should begin with the wealthy, but lawmakers cannot rely on that as the sole way of raising revenues to offset federal spending. An aggressive package of new taxes on corporations in the top 1% to 2% of households could raise at most 2.1% of GDP in revenues, meaningful but not sufficient to stabilize the debt, according to Peter J. Peterson Foundation. Government spending is so large that broad taxation is the only answer. This taxation should be progressive in the sense that it should fall on the wealthy the most and least on the less fortunate. But that should not neglect the reality that today's Americans must pay for the free lunch of yesterday's Americans who built up that debt. Some broader tax measures could include, quote, Peter G. Peterson Foundation again, the tax exclusion for employer-paid health premiums is one of the largest tax breaks in the U.S. tax code, therefore indicating a source of untapped revenues. Furthermore, implementing a 20% value-added tax, VAT, would also help raise revenues. Out of the countries in the Organization for Economic Cooperation and Development, OECD, which is a member group of high-income countries, the United States is the only country that does not have a VAT. The lack of a VAT is the central reason why countries in the OECD collect an average 34.1% of GDP in revenues, while the United States collects 26.6% of GDP, end quote. In regards to cut, spending is a problem of growing entitlement costs. The largest category of entitlements are directed at older people through Social Security and Medicare. As discussed before, the inverted demographic pyramid destabilized this entitlement model because there are more older people taking out than young people putting into the system. This challenge will just have to be white-knuckled through until fertility rates improve to fix this in the long term. Since this spending is mandatory, along with entitlements for poor people to not starve or become homeless, the only discretionary areas to cut are particularly located in the defense budget. According to the Quincy Institute, about 800 U.S. military bases on foreign soil cost U.S. taxpayers $80 billion per year. The Quincy Institute also found that at least $60 billion could be saved per year through minor improvements like, quote, canceling or reducing spending on dysfunctional or unnecessary weapon systems, making process changes that will encourage greater spending discipline, reducing bureaucracy, including both governmental personnel and the department's hundreds of thousands of private contract employees, and cutting excess basing infrastructure, end quote. The biggest cost savings will be from reining in America's bellicose war footing. It should not be forgotten that America's Middle Eastern wars cost American taxpayers about $4 trillion in total. In the era of foreign war fatigue and focusing on America first, military spending related to America's overextension in foreign affairs is the low-hanging fruit to make meaningful cuts. If the U.S. can grow, tax, and cut, it may get out from under this debt problem. An implicit fourth solution is the byproduct of doing the three others, which is increasing demand for U.S. debt. If domestic and foreign investors see the U.S. moving ahead on all three fronts, their appetite for U.S. debt will increase. This allows for any remaining deficit to be covered by these creditors. And just like that, America's problems will be solved. But that's not the America we live in. America got to this point because of constraints and malfeasance. America's old age demographic problem is a mathematical certainty, not something that can be fixed with a magic wand. You can't create more young workers or reduce old consumers overnight, nor can you create the next great technological innovation at the drop of a hat to increase productivity. Further, politicians can't run on increasing taxes to sufficient levels and win. Voters, especially older ones, will vote against that every time, as well as any politician that talks about cutting entitlements. America's economic growth is centered around activities like the speculative AI bubble and increasingly extractive services. For example, from 2019 to 2024, the gambling sector grew at the second highest rate in output, only behind software publishers, obviously tied to the AI bubble, according to the U.S. Bureau of Labor Statistics. America's ruling elite derived their wealth from these activities and will simply not sacrifice their short-term interests for the long-term national good. This same ruling elite has economic and ideological motivations in regards to America's foreign policy. Many derive profits from America's military spending and opening up of foreign markets. Many have an unshakable hubris to commit America to more foreign wars that one can only maintain by being as far from the battlefields as possible. Taken together, the demographic and electoral constraints, as well as the decadence of the American ruling elite, prevent America from enacting the necessary reforms to avoid slapdash solutions like stablecoins. America choosing the wrong path is already a fait accompli. America's ruling elite have the psychology of a manic gambler on a losing streak who thinks that if only he bets his house, a win will come. When the stablecoin crash comes and blows up the economy, the U.S. government will be left with only two bad options, since growing, taxing, and cutting are irrelevant in an economic collapse. One, the U.S. could monetize its debt through the central bank, which historically leads to hyperinflation. Two, The US could default on its debt, decimating its ability to finance future debt and scaring off investors. With options like this, it's likely America gets worse before it gets better. Countries like Argentina go through conditions like this all the time. Things aren't great, but Argentina still exists. Then again, America is falling from a much greater height. Thanks for listening. If you enjoyed this, please subscribe, like, and share. This way you can stay up to date with any future videos, podcasts, or articles I may have, and you can spread any insights that you found helpful. In addition, if you want to know more about cryptocurrencies and stablecoins and the intersection of them with US government debt, please jump over to my Substack and find my seminal ebook, Money by Vile Means, which is the definitive deep dive into critiquing Bitcoin, cryptocurrency, and this collaboration that the cryptocurrency sector has gotten into with the US government under this new Trump administration.